All right, warm welcome to everybody. We're delighted to be joined again by Tony Steels, the CEO of MPAC, and also by Will Wilkins, the Finance Director. The results have just come out this week, first half, and looks like an interesting period, Tony. I don't want to summarise for you, but a lot of momentum last year, one or two stumbles along the way, but it sounds as if the group is in good shape again at the end of the period and ongoing. Is that a fair reflection?
I think that's a fair summary there. Yeah, we had as we've made clear in the announcement, it was a challenging first half. But we're 18 months into a 5-year strategy, and in our industrial environment, capital equipment, you expect some bumps in the road, some periodic sort of changes to the sort of the investment cycle. But the upside of that is that we've thoroughly reviewed our order book on the basis of the two adverse contracts we had, and we're now very confident that we've got a deep understanding of that order book in terms of complexity, lead time, cost, so we can confirm that the forecast for the end of the year is intact. And we've made really good progress over the last 6 months on our strategic objectives, putting in place a lot of good foundation blocks for the future, common systems across the company to really bring the strategy to life of operating as a single entity business.
And just to kill off the so-called legacy issues, and it does look as if they are now killed off. Provisioning and remediative steps have been taken. By the end of this year, will they no longer be a problem?
Well, there are two contracts that we pulled out in the report. One, the UK-based contract, will actually run on until the second half of next year, just because of the sheer size, scale and complexity of it. We're in the commissioning phase, so we're confident now that we've got through the main engineering challenges. Now it's a question of hours and time to complete the commissioning. We've discussed in detail with the customer. The customer's comfortable with our revised lead time, so we know where we are on that project, and we're confident that will be closed second half of next year. And when the line's delivered, it will provide the customer with really a unique position in the market, being able to rapid prototype medical devices to their customers. Clearly an advantage over in their competitive area. The other project, a Canadian based project, that will be completed this year. We expect in October, November time. I think, as maybe you put in the half-year report, that we if I go back to the basics on our line, there's three elements. Is the fill part of it, which is putting the base product in a plastic wrapper usually, and then there's the cartoning part, putting it in the cartoner, which is one of our main product lines, and then case packing. We were only engaged to provide the cartoning part, which is the middle part. So we tested the equipment in Canada. We got the customer's acceptance at that point. When we delivered the line, the product that was being fed to the cartoner was of substandard quality, which caused other knock-on impacts. We were not absolutely clean on our side. There were some things we could have done to improve the machinery, but we were impacted by the upstream equipment. We've now resolved that with the customer. We've got a plan to upgrade the equipment, and that will be done by October, as I said earlier.
Well, I'm sure we'll come back to the results, but you raised the interesting point there about the client seeking innovation. And we are in a rapidly changing world when it comes to delivery of consumer products, etc., etc. How much is MPAC embracing that flexibility and ability to change, to be at the forefront of what customers need?
Well, it's absolutely key to what we're trying to do. Just as an example, our head of innovation reports directly to me, and I've been personally trying to push innovation program for the last couple of years in the company. And the culmination of that is that we have an exhibition in Chicago in a month's time, which is the largest exhibition in the Americas once every 2 years. And we're showcasing some new products there. We've got a new case packer, which has got massive advantages for the customer in terms of footprint and control. We're launching a new HMI control, which is a human-machine interface, the control pad that you see on the machines with the red buttons and the green buttons, but the software behind that, and innovating on the existing product line to further improve it. So we've got an innovation pipeline now starting to come to fruition, but behind that is an awful lot of other projects that we're building up to keep at the forefront of our leadership position in the industry.
Well, maybe let's talk a little bit about the order book that you've already referred to, and I think in the statement you made a point of saying that it's now of better quality and lower complexity.
Yeah.
Can you expand on that for the layman out here?
Well, yeah. When you're faced with challenging projects, as we discussed earlier, you naturally then want to look through the rest of the order book in more detail. We have looked through it before. It's not the first time, but faced with that, we needed to be assured. And I think we started off in the Canadian business and went through that. We've had a number of our people from the UK go through it. But the other thing is it's fostering it's really bringing the strategy forward and make people in our group are standing forward now, and the more senior knowledgeable people are getting involved in these projects across business to undertake peer reviews, which I think is gives us more confidence that we're doing the right thing. So we're looking at the concepts that we've sold already to our customers. We're looking at the lead times and the costs, and we're a lot more confident than we were before that all these projects now, we've got a good understanding of the order book going forward and the forecast for 2019. Mm-hmm. On top of that, we implemented a CRM system last year, customer relationship management tool. So we've got much more visibility of our pipeline. And one of the comments I made in the half-year report is that the market there was a softening of customer investment cycles. And what we've seen there is two aspects, really. The first aspect is on a macroeconomic scale, and I really don't like talking about things like that because they are changeable and out of our control anyway. But one of the things we've seen is some large corporates are deferring investment decisions. Mm-hmm. Conversations recently with GSK, with Kellogg's, and they are doing capital reviews, which means that the projects do move out to the right.
This is very much a global situation, right? Global. You can't lay the blame at Brexit for UK companies.
This is just uncertainty on a global level because of different market dynamics in the Americas. They've got their trade relationship with Canada is a hot topic, similar to Brexit in Europe. Mm-hmm. Brexit is an issue, but also China as an industrial power is for the first time, I think, in a generation, not hitting its double-digit growth targets. So these things do impact and slow things down. More closer to home for us is the industrial niches that we operate in. Last year we had a really good run with packaging machinery for the contact lens industry, for instance, and I think I may have mentioned pizza cartoning. We did numerous projects last year for pizzas. This year, clearly there's enough capacity now in the markets for packaging pizzas, and contact lenses, they are going through a phase of installing the equipment rather than new investments, but we fully expect that to change around in 2019. So it's a timing issue in terms of where some of these projects are. We're not losing projects, they're just moving a little bit more to the right than we anticipated.
Mm-hmm. And in terms of visibility, we've seen in analyst notes that looking at 2018, they're confident that 90% of your revenues are now covered. Yeah. Presumably you're happy with those forecasts if you're seeing them out in the market.
Yeah, no, we've seen them out in the market, and we've discussed in detail with the analysts, and we are in the fortunate position with our original equipment orders. They do tend to take 6 to 9 months to come to fruition. Mm-hmm. So the orders we have now, we can see for the next 6 to 9 months what's happening.
And the revenue will impact in 2019.
Absolutely, yeah. And we had the benefit. You may have read in the announcement since we did our trading update at the end of June. Mm-hmm. Since then, we've managed to secure a significant contract with a US-based company, which will give us, really good order coverage going into 2019. So that gives us further confidence that we will return to the growth trajectory, and the work that we've done this year, overcoming the challenging contracts and the review of the order book, will bode well for our growth in profitability next year.
Mm-hmm. And looking at some of the subsets within the group, slightly disappointing performance from services in the results this time around.
Yeah, that is an issue that we're obviously conscious of, and we are working hard to resolve. What we have done on the positive side is we've put in place the regional management structure now. So we've got a head of services for the Americas, a head of service for EMA, and a head of service for Asia, and we've recruited a number of service technicians. The issue with the revenue growth is because we grow so much in 2017 and the early part of 18 in terms of top line sales, that sucks in your best people into installation and commissioning, and then you recruit new people, and that has a temporary adverse effect of diluting your service resource because they need to be trained. But we've now got those people on board. They are trained. We've got the structure in place. So we're really very conscious to start to leverage that now and delivering growth on service.
Mm-hmm. And away from the organic opportunities, again in the statement you are looking at M&A and bolt-on opportunities, but haven't actually closed any. What sort of criteria are the ones you've looked at failing your targets on?
Well, we looked at 3 in detail last year. We got to heads of terms with one and started the due diligence. And the issue with that business was the forecast started to look very weak once we got into the detail. Mm-hmm. And because it's in a similar industry to, it's the same industry as what we're currently working in, we can very easily and quickly review the forecast and test it against our own internal metrics. And it just did not stand up. And then you start to look at the value of the business compared with the forecast going forward. And the seller was just not willing to, rediscuss the selling price. So we backed away from that one. We looked at another business in Europe, and it became quite clear to us that the management team would need quite extensive restructuring over the short term, which we felt would again be another diversion from our organic growth story and what we're trying to do as a business. So on those two, we decided that they weren't for us. We're still looking at acquisitions. We've got a small number of companies that we're in conversations with, but these are off market, usually privately owned, and these things take as long as they take. It's not something that we can put a timescale around.
Mm-hmm. And I suppose that leads on to, we just talked a little about the future and dividends. Understandable given the opportunities externally and internally to invest capital at the moment, that the decision's been made to not pay dividends. What sort of criteria or what changing conditions do you think would be in place from your perspective to start thinking about bringing them back?
Well, I don't want it to sound overly simplistic, but for us it's generating free cash. Mm-hmm. Once we're in a position that we are generating free cash and the level of profitability gets to the level where that's the case, then we will return to that policy. Yeah,
it's a nice simple policy. Lots of moving parts in it. We can talk with Will a little bit about the pension situation.
Can add colour to that.
But before we go over to Will, we might just touch on the land and the property at Monk's Risborough, which
I smile because that just everybody's
might yet be a positive. But
I will at some point.
It's out of your hands now.
Yeah, that's the thing. Anybody who's dealt with property over their lives, knows that these things have got a life of their own, and so you don't get too excited by it. But the situation on that is quite clear. We put in a planning application about 3 years ago to Wycombe District Council to have the land taken out of Greenbelt and area of outstanding natural beauty and put a planning application for residential properties. That was rejected. We appealed all the way up to the Secretary of State, who upheld the rejection, unfortunately. But the process of doing that, there was about 7 or 8 criteria that it was rejected on, and we've eliminated at least 5 of those. Mm-hmm. It's still an area of in green belt, but anybody who knows the piece of land can see that it's surrounded on 3 sides by residential buildings. So it's not some dreamy green glade somewhere. So we're now back to Wycombe District Council with a revised plan, and our advisors and council have seen that there are a number of green belt pieces of land within Wycombe District Council that have been reallocated to residential development. And if we consider our piece of land on the same criteria, ours would sit very comfortably in the 6 or so pieces of land that they've already released. So we're in that process now, and we should have a conclusion to the latest planning application early next year.
Early next year. Well, the climate or the provision of new housing is a hot political topic all the time.
Absolutely. The macroeconomic thing there is there's not enough land in that area for the developments. Okay.
Well, that's very helpful. I think we'll now talk to Will about things that you can control within the group, and then perhaps come back to you for a summary afterwards.
Thanks very much.
Right, well, good to see you, Will. A few months into the job, although almost a veteran of the company, if you don't mind me saying that. Lots of interesting things in the half-one report. I think you're the best person to pull out the key numbers.
Okay, sure. So a quick overview of the half-year performance. As Tony has mentioned, top-line growth, very strong, exactly where we stated we were aiming for within our strategic intent, 11% revenue growth to 28.2 million. Predominantly that growth has come from the EMEA region, where we have seen 45% growth on the first half of 2017, so really strong. Asia as well has performed admirably, up 16%. A few challenges in the Americas, mainly driven by the fact we moved to a new facility at the turn of last year, moved the whole production and administrative function to a new plant, and that's taken a few months to bed in and get back up to productivity levels that are more normalised. But we're there now, but that has had an impact in the first half of the year, so slightly behind in the Americas region. By sector, healthcare has been the real star performer in the first half, up by 47% on the first half of the previous year. So
which is already your largest segment anyway.
Food and beverage is our largest segment.
Sorry, my mistake,
Yep.
yes.
But healthcare, supported by the closing order book at the back end of last year, so predominantly contact lenses is a really strong area for us, which is part of our healthcare revenue stream. So we've benefited on the back of strong order book from healthcare at the back end of last year, and that's been one of the main drivers. The two technically challenging legacy contracts that have been well discussed now, obviously that's been the main contributing factor to the profitability in the first half, and that additional 1 million of cost to complete those contracts has had an impact, and the profit before tax in the first half is at break even. Obviously excluding those projects, it shows we do have some strong foundations and a good profitable project base excluding those two projects. But yeah, we're at break even at the first half, slightly behind where we were last year. But as part of the onboarding for me coming into this role, I obviously wanted to do my own due diligence, and we've done that deep dive on the order book. We're very confident the quality of the order book is stronger now. We're going into the second half of the year confident that we can meet our forecasts.
And then do you want to say a little bit about raw material costs, which obviously important to your business, but at the moment don't seem to be a problem, but are you looking forward to constantly address what might happen to commodity prices?
Well, we're mainly exposed to prices of steel when we come to raw materials. We're not a huge consumer of raw materials per se, but we do have a supply chain strategy which is focused around finding strategic long-term partners within our supply chain and driving through efficiencies, utilising their buying power as well as our own. So yeah, we're in a fortunate position at the moment, having just started that strategy, that we're actually benefiting from those strategic partnerships as opposed to experiencing any negative impact on our cost base from raw material price increases.
Okay. And perhaps there's a good opportunity to talk a little bit about the pension,
Sure.
which is a significant factor in how people look at the balance sheet, your future commitments. And, if you can update us on the review process there.
Sure. So as the overview, we have one UK pension scheme and we have 4 schemes in the US. On an accounting basis, the UK scheme is reporting a surplus at the half year of 35 million, and the US scheme's a deficit combined of just below 6 million. So yeah, on an accounting basis, we're in good shape, and it's part of our healthy balance sheet at the half year. On an actuarial basis, we are about to enter the next valuation cycle, the triannual valuation. That will kick off in the second half of 2018, and we are active now with advisors to benchmark the assumptions that were used in the previous triennial valuation to give us a good understanding when we enter the discussion with the trustees about the assumption used for the next valuation. So clearly the strategy is to get to the point where the scheme in the UK is as close to fully funded as possible, and then the company has options on how to move forward thereon. There's probably not a huge amount of benefit in talking about what those options are until we get to the point in time when it is fully funded. And as much as we can influence that, we're going to be influenced by external factors such as interest rates and inflation. So it's probably something to work towards over 1 or 2, perhaps even 3 valuation cycles to get to that point where it's fully funded or close to and at that point, the options become a bit more interesting.
Great, well that's very helpful. Perhaps we'll just cut back to Tony for a summary and wish you good fortune
Okay, thank you.
in the role.
Thanks for the time.
Great, thanks for that, Will. Tony, let's just look a little bit further down the road to finish. As you mentioned right at the start, you are only a third of the way into a 5-year plan. What will the shape of the group be at the end of that if you manage to succeed on your strategy? And I'm talking more about the shift to e-commerce, software services being an important part of the group, as opposed to being the capital goods metal basher that perhaps the group was in days gone by.
Well, there are two extremes there, aren't there? Metal bashers to e-commerce, and there's quite a lot
the
of
world's
room in
never
between.
quite that stark and simple, but
No, but
you're
it's
clearly trying to progress the group
yeah.
to a more value-added, higher margin proposition.
Yeah. Well, I think the first thing on that is that our global presence is a clear USP, and that's something that we need to continue to develop. And Asia is an important part of that going forward. The market is split a third, more or less, between the Americas, Europe, and Asia in terms of the overall market size. So, growth in the global sense is really important. The products, as you alluded to, I'm not convinced that mechanically we're going to see huge leaps of innovation over the next, let's say 10 years. And on the electrical side of the controls, I'm not so sure we'll see huge leaps in innovation. But in terms of control and software, we will. And we now some of our customers. In fact, a case study that we showed last year with CooperVision, to use the terminology, going from batches to each. And we had an absolute example last year where CooperVision for contact lenses are targeting direct dispatch to the individual's address of their individual prescription. So we're already at the forefront of some of these things, but it's still quite a fluid market in terms of what customers want. So we're working very closely with our top customers to understand those market dynamics. So the innovation program that underpins what we're doing will be more about services, more about data extraction from the lines, traceability, and quality control within the line, so that you can maximize the uptime for the customer. On top of that, quick changeover times are really important as well. Most of the time, our customers will buy a packaging line with a variety of products in mind, and that's increasing, so the variety is going up, and the time that they target to change over from one product to another is coming down all the time. So matching that quick changeover, shorter batches, with data traceability and unique product identification is really the key to this. So our direction is to follow that and to try to develop the products more around that, using your phrase, the e-commerce.
Yeah. And your customers have to have that engagement with their end consumers. So you're a critical part of the chain. Yeah,
there are some restrictions. One of the things is the customers are still quite nervous about connections directly to their systems, because of IT, internet securities. So, but we're overcoming that with different solutions to have the access to the machines, insulated or isolated from the overall networks. So we are very well aware of what the challenges are, and that's our path of travel, if you like, direction of travel.
Yeah, well, it's a very good mantra that the long journeys are best accomplished with a series of short steps. That seems to be the progression. So let's hope at the end of the tunnel there is double-digit growth from that sort of business, which would imply double-digit EBIT margins, and anybody could do the maths that the value of MPAC in that situation would be many multiples of the current market cap. So.
Yeah, you can do the maths, and I think you can see over the last couple of years now we've generated growth, way beyond our expectations in the first year. I think it was 38% growth this year. Up to now, it's 11%. It's slowing down a little bit at the moment, but I mentioned the 2019 forecast a little bit earlier. So we are definitely getting the momentum in our company, We've worked really hard over the last couple of years as well on our internal structures and costs, so we're getting the profitability. We've got some really interesting projects on supply chain and engineering to improve our competitive going forward. So I think the business fundamentals are being put in place to give us that platform for growth. So our ambitions remain absolutely steadfast towards double-digit growth over the strategic period, improving the return on sales. So I look forward to getting up towards the target share price that was indicated in the analyst report.
Yeah, I've put a date in my diary for 2023, so we'll see how we're going then. But thank you both for your time and insight today. We wish you the very best of luck, and for anybody who wants to see external forecasts, there is of course a recent equity development note written by Paul Hill, which does stray into the areas that Tony can't comment on, but does give a reasonably positive outlook. Thank you.
Thank you.